Hey, welcome. Today we're going to tackle one of those huge financial questions that, let's be honest, can feel totally paralyzing. Should you take any extra money you have and throw it at your mortgage? Or should you invest it for the future? It feels like such a high-stakes decision, right? But here's my promise. By the end of this, you're going to have a super clear framework to make the right choice for you and feel completely confident about it. So, let's dive in.
Okay, to kick off our little quest here, I want you to imagine something. Let's say you've come into some extra cash. Maybe it's a work bonus, an inheritance, or you've just been saving like crazy. It feels like you've just stumbled upon a hidden treasure chest. So let's meet our hero for today, Clara. She's got this treasure, and she knows it's the key to building a better future, but she's just standing there, frozen, at a crossroads, absolutely terrified of taking the wrong step.
You see, down one path, she has the option to tame the house monster. She can use her treasure to fight back against that massive mortgage debt, working towards the guaranteed safety and just the incredible peace of mind that comes with owning her home free and clear. But then, there's the other path. On that one, she can try to grow a magic money tree. She can plant her treasure in the market and hope it grows into something that could fund all of her biggest dreams down the road. So, what does she do? Does she pick the guaranteed safety of slaying the monster, or does she go for the potential growth of the magic tree? That right there is the puzzle we're going to solve together today. Now, every great quest needs a map, right? And this is ours. We're going to move through 6 distinct stages. We'll start with understanding the treasure in the puzzle. Then, we'll check our defenses. After that comes the great numbers duel, followed by listening to our inner compass. From there, we'll choose our adventure. And finally, we'll solve one last tax riddle. Think of this as your step-by-step guide to get from that feeling of confusion to one of total clarity.
So there's Clara, with her treasure chest and this huge puzzle sitting in front of her. But before she could even think about which path to take, every single wise adventurer knows there's a preliminary quest they have to complete first.
And that brings us right to Section 2. First, check your defenses. Look, before any knight goes off to seek a great treasure, what do? They put on their armor. They make sure their castle is secure. It's the exact same thing in finance. So there are 2 absolutely non-negotiable defense checks we have to perform before we even think about the mortgage or investing.
And here they are, your 2 primary lines of defense. First, you have to build an emergency shield, and second, you have to defeat any high-interest dragons. Now listen, these are not suggestions. These are not just good ideas. If your treasure chest is needed for either one of these, well, the decision has already been made for you. The money has to go here first. Let's break down exactly what that means.
Okay, first up is that emergency shield. You probably know it as an emergency fund. It's really simple. It's just 3 to 6 months of your essential living expenses, rent, food, utilities, stashed away in a safe, boring, easy-to-access savings account. Now, this money isn't there to make you rich. It's your financial bodyguard. It's there to protect you from those surprise attacks life loves to throw at us. A sudden job loss, an unexpected medical bill, the kinds of things that can completely wreck your plans if you're not prepared. So before you do anything else, you have to make sure this shield is fully built. All right, next up, you have got to slay any high-interest dragons. What are we talking about here? This is any debt with an interest rate over, say, 8%. We're talking credit cards, personal loans, that kind of stuff. Think about it. A 20% interest rate on a credit card isn't just debt. It's a dragon that is actively breathing fire on your money, burning up your wealth way faster than any investment could possibly grow it. Paying this off gives you a guaranteed, tax-free, and frankly, unbeatable return on your money. So if you have this kind of debt, you take your treasure and you slay that dragon, end of story. No question about it.
So let's say Clara's in a good spot. Her defenses are strong, she's got her shield, and she's totally dragon-free. Now, finally, we can move on to the main event. Section 3, the great numbers duel. Because at its core, this decision really starts as a simple math problem. We're going to put the house monster in one corner and the magic money tree in the other, and we're just going to let the numbers tell us who wins.
And to judge this duel, we really only need 2 numbers. That's it. First, you need to find out your mortgage's APR, its annual percentage rate. Second, you need to make a realistic, a conservative guess about what your net investment return might be. Once we have those 2 numbers, we can just put them side by side and see what's what.
Okay, first, let's look at the house monster's true power, its APR. This is the real, total annual cost of your loan, once you factor in all the interest and fees. This is the monster's official appetite, how much it's eating every single year. You can usually find this number right on your mortgage statement. This number is our benchmark because paying down your mortgage gives you a guaranteed return that's exactly equal to this APR. So for our story, let's say Clara's APR is 4%.
Now let's talk about the magic money tree. Its return is, well, it's not guaranteed, right? So we have to make an educated guess. You might hear that historically, the stock market returns 8 or 10% a year, but hold on, we don't get to keep all of that, not even close. First, we have to subtract a couple of percent for inflation, which eats away at our buying power. Then we have to pay taxes on our profits. So after all that, a really realistic, conservative, long-term net return to expect is probably somewhere around 4 to 5%.
And so here it is, the duel. On the left, we've got the house monster's guaranteed 4% return from paying down the mortgage, and on the right, we've got the magic money tree's potential 4.5% return. And would you look at that? The bars are incredibly close. I mean, the investment's potential is a little bit higher, but it's basically a tie. And this right here illustrates the core dilemma perfectly.
So this duel gives us a really clear rule of thumb, a kind of cheat sheet. If your mortgage APR is pretty high, let's say over 5%, the math is pretty clearly in favor of paying down the mortgage. That guaranteed return is just too good to pass up. Now, if your rate is super low, like below 3%, the math definitely favors investing. But if you're like Clara, and you're in that murky middle zone between 3 and 5%, well, the numbers have basically fought to a draw. And when that happens, we need a totally different tool to break the tie.
And that brings us to Section 4. When the numbers can't give you a clear winner, it's time to consult your inner compass. This is where we look beyond the spreadsheet. This is about your personality, your feelings about money, and your biggest life goals. And there are 3 key questions you need to ask yourself.
First, and honestly, this might be the most important question of all, which path lets you sleep soundly at night? This is all about your personal risk tolerance. You see, paying off your mortgage, that's like sleeping in a fortress made of solid rock. It's absolutely 100% safe and secure. Investing, on the other hand, is kind of like sleeping in a comfortable hammock on a beautiful hilltop. The view is incredible, the potential is huge, but you're gonna have to ride out some storms. You just have to be honest with yourself. Are you a fortress sleeper or are you a hammock sleeper?
Second question for your compass. What's your time horizon? See, investing has this incredible superpower. It's called compounding. It's where your earnings start making their own earnings. It's like a tiny snowball rolling down a very, very long hill. It starts off slow, but over time, it becomes this unstoppable avalanche of growth. So if you've got 20, 30, or even more years until you need the money, compounding gives a massive advantage to investing. But if your timeline is shorter, the security of paying off that mortgage starts to look a lot more attractive.
And the final question from the compass is all about access. How easy is it to get to your treasure if you need it? This is what we call liquidity. Money you have in an investment account is liquid. It's like a glass of water on your kitchen table, ready for you to drink whenever you want. But money you pay into your mortgage, well, that's like taking that glass of water and pouring it into the cement of your house's foundation. Sure, the foundation is stronger, but you can't get that water back out. It's illiquid. And that's a really important difference.
Okay, we've done the work. Clara has completed the analysis, she's dueled with the numbers, she's consulted her inner compass, and now, armed with all of this knowledge, she is no longer paralyzed by fear. Not at all. She feels empowered, and she is ready for Section 5, choosing her adventure.
And here they are, the 3 main paths she can now confidently choose from. There's the prepayment path. This is for all the fortress sleepers out there, focusing everything on taming that house monster. Then there's the investor's path. This is for the hammock sleepers, focusing on the long-term growth of the market. And then there's the third option, the hybrid path. This is a balanced approach that just might offer the best of both worlds.
See, the hybrid path proves that this choice doesn't have to be all or nothing. Clara could decide to split her treasure right down the middle, use half of it to pay down the mortgage, locking in that guaranteed return and peace of mind, and then invest the other half for that long-term growth potential. This approach is really powerful because it minimizes regret. You get to capture some of the benefits from both worlds. Clara feels this huge wave of relief. She can finally see a clear path forward. But before she sets off, she looks at her map and sees one last small section. A final little puzzle to consider. This is Section 6, the final tax riddle.
Let's look at this final riddle, taxes. And here's the key difference you have to understand. When you make money in the market and sell your investments for a profit, those gains get taxed. You have to give a cut to the government. But the interest you save by prepaying your mortgage, that is a completely tax-free return. This is a really critical point. A 4% tax-free return can actually be more valuable than a 5% taxable return. This definitely adds a little more weight to the tame the monster side of the scale.
And just like that, the quest is complete.
You see, the goal here was never to find the one single correct answer for everyone, because it doesn't exist. The goal was to find the answer that's right for you. And now you have the framework to do it. You check your defenses, you run the numbers, you consult your inner compass, and then you choose your adventure. So the only question left is, when you find your treasure, which adventure will you choose?